Improving Alpha Innovation in Investing, ESG and Technology with Michael Oliver Weinberg in partnership with Vidrio Financial. Vidrio Financial is a premier data management provider shouldering the responsibility for your data from collection to extraction, transformation and enrichment. Vidrio monitors over 2,000 diverse funds, processing millions of data points each month. Discover how Vidrio empowers your institutional portfolio data by combining advanced AI and human expertise to yield comprehensive analytics on performance, cash flow, risk, valuation, and more. All delivered seamlessly through Vidrio's Data Management Hub. Save your investment team valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Hi. This is Michael Oliver Weinberg. We would like to welcome everyone to the Improving Alpha, Innovation in Investing, ESG, and Technology podcast series. Today, Jonathan Bellack, author of the Platformocracy newsletter, will be our guest. So listeners have a high-level sense of our roadmap. We will start with some background, then discuss the usual. Investors, academics, and business leaders should be able to extract a great deal of value from Jonathan's insight. On that note, welcome, Jonathan.
Thank you, Michael. It's great to be here.
Why don't you start with your background? Briefly, how you got to where you are today.
Sure. I was lucky enough to graduate from college right into the dot-com boom back in the early and mid-90s and really fell in love with the possibilities and the rapid changes in the world that the internet brought. So I worked at a series of typically failed startups in New York City, out in Silicon Valley, a little bit of time in London, and then came back to New York City to get my MBA at NYU Stern, graduating in 2004, which led me to one of the few internet companies in New York City at the time called DoubleClick, one of the pioneers of digital advertising technology. I ended up becoming the leader of their publisher ad serving platform, which led me all over the world working with newspapers and blogs and eventually video creators and apps, helping them build and grow sustainable businesses with advertising. DoubleClick was purchased by Google in 2008, which really opened my eyes to the big tech world, going out to Mountain View regularly, continuing to expand the business everywhere, and eventually leading really large product management teams and designing strategies that were affecting billions of dollars of revenue and working around the world. Towards the end of my time at Google, I got much more concerned with what the internet was becoming and the problems of the internet. And I used to joke I wanted to make it a slightly less horrible place. So I shifted over into working on counter abuse and digital safety technology, eventually leading product management for Google's central counter abuse technology team. I left Google in early 2023, in part because I'd had a great and fulfilling career and wanted to shift into more helping and a little bit less leading, and also just really having a feeling that we needed new kinds of thinking to figure out how to incorporate the internet and social media and the continued changes that was imposing on us into the future and finding a sustainable way forward. I now write a free weekly newsletter called Platformocracy that talks about how we got into this situation of large companies effectively becoming our unelected governments and advocating for new approaches to bring democracy out of our real world lives into our online lives as well.
Got it. And we've never discussed this, but we have multiple of the founders and people in common from DoubleClick, but we'll save that for an off the podcast conversation.
Awesome. It's a small world.
Always. Anyway, all right, let's get into the meat of the conversation, so to speak. Let's start with governance of the algorithm, or the G in ESG. Let's talk about platformocracy and voting. You created the concept platformocracy, and my sense, and you'll correct me if and where I'm wrong, and there will eventually be a question. There's this lack of participatory governance in digital communities. It's a bit like the antithesis of democracy, and you believe it should be the other way around. So for an asset owner or anyone for that matter, that would be a shift in control. I guess the question I have is, well, first I'll let you start with what platformocracy is in your own words, and then I guess the question I have is, should the government require tech companies to provide a transparent democratic process? For example, if they want to vote people off their respective social media islands, and or should the government go even further than that? So I know I've said a lot and asked a lot.
Yeah, it's a great question, and there's a lot to it. The core of what I've come to believe is that the way we're approaching online communities is sort of out of whack with the way we approach the real world. There's an excellent concept by an academic named Nathan Schneider called implicit feudalism. And what it observes is that the nature of technology, computer systems, is you have someone who has absolute control over it. Somebody is the administrator of the server. Somebody's maybe running the server in a physical location and they can always just turn it off. And that's the sort of absolute monarchy approach to decision making that has spilled over into the way these large technology companies run, where the executives of a big social media company decide what the rules are going to be and sort of announce that to everyone, and then handle all of the enforcement of the rules without anything that looks like due process or a criminal justice system. It all happens behind closed doors, and you really have no recourse. And if you look at the history of real world societies, there's been hundreds of years, arguably millennia, of debate and work and revolutions and legislation to create the notion that people deserve a say in their own societies, whether it's the direct democracy of Athens, where the subset of people who were citizens came together to make decisions, or modern representative democracy, where we elect people that are supposed to be looking out for our interests in the governments they're a part of. We should be looking at bringing something like that into the online world. Now, where that goes and what you talked about is some really interesting questions about government action and how that relates to the notion of companies and firms as it exists today, because there tends to be an immediate reaction of like, well, the answer, if you don't like the way a company is operating, is just go to another company. Companies are entitled to make their own decisions about how they work and how they serve. That is loosely true, but also not invariably true. You have things like common carrier requirements. You have requirements around utility provision with electricity or phone lines. You had things like the broadcast regulations around assigning spectrum. The notion of the government having some intervention into how companies operate in order to achieve goals is definitely something that's out there. Now, in terms of saying what a government should be involved in, ultimately, I think this has to come from a dialogue between the communities that are using these platforms and the people that are running the platforms. I don't know that this is something where you can just go to a government and say, if you just pass this one law, everything will be okay.
Right, right. It's complicated. That makes sense. Okay, well, let's move to data sovereignty and portability. And this, I think, dovetails nicely into what you just delineated. Let's start with the right to exit. When we last spoke, you talked about mobile phone portability and how that was not a thing until finally the government forced it to be a thing, and it was complicated, but it was, of course, viable. My sense is your view is there should, of course, be portability for consumers on these platforms, and currently there isn't. I think you cite, again, when we spoke, you cited an example of that. Obviously, the platforms don't want it because that's their moat to maintain their monopolies or oligopolies, whichever may be the case. So they'll fight it tooth and nail, and obviously it would be adverse for their profitability and their ecosystem. So what are your thoughts on all of that?
Yeah, a lot of my thinking has evolved from a really outstanding, easy to read book. It's a classic of business literature called Exit, Voice, and Loyalty by a gentleman named Albert Hirschman, who was a really interesting guy. It turns out he was like a World War II badass and then became a business professor. And what he talks about is this notion of exit is one of the critical ways that any consumer base, any customer base provides signal back to the firm that correction is needed. If you're manufacturing shoes and you've got low quality shoes, people can exit by no longer buying your shoes and buying your competitors. Your sales go down, you get an indication that maybe something's not right. You can look into it and try to correct. It's a critical part of what makes markets work. From there, you can have things like voice, which is someone saying, I could leave, but I don't want to leave. I would prefer that you fix things. And that's driven by loyalty. Do you have a relationship with the organization or the firm that causes you to want to stay there? Like if you've grown up buying Nike sneakers and you feel like their quality is dipping, but you really being a Nike guy and having your Air Jordans is a big part of who you are, you're more likely to tell Nike, please fix your shoes rather than just jump to Adidas. This is all really important stuff, and it's pretty much broken in the world of social media in particular and in other parts of the internet as well, because you can't functionally exit. These companies do provide often some sort of download of your material, but you can't take your social graph from Facebook or Instagram or your followers from YouTube or TikTok and move to another platform and recreate that. You sort of have to start over from scratch. And what that does is it breaks exit, which means it's very hard for people on these platforms to provide signal back to the firm where they believe there are problems of performance or underperformance or issues. And so it's not good for these communities. It's also not good for the firms in the long run. How do you get to the point where internal leaks are reporting that the Meta Corporation is making something like 10% of its ad revenues from scams and fraud and fake product ads? That's not good for anyone. That's not good for Meta as a company either, to have that much of their revenues hinging on something that's illegal or harmful. But there's no real way to get signal back. And so if you had credible exit like mobile phone number portability, where you could pick up a Facebook group and reestablish it somewhere, if you were not happy on X or using YouTube as your video distributor, that you could pick that up and move somewhere, you'd have better signals back to the firms. And I think you'd get better products and better experiences all around.
Interesting, interesting. Yeah, that certainly makes sense. There's no feedback, and it's really a one-way street in many respects. Okay, let's talk about along the lines of data and data sovereignty and portability. Let's talk about, we could call it, I guess, flipping ownership. Right now, or historically, the internet's been built on services in return for data. Everyone, the current and recent generations want everything for free. And what they do or don't understand, I think there are probably two constituencies, is that they're obviously, and I'm not telling you anything you don't know, they're getting their services because they're providing their data. Going back many years, so when you mentioned the first tech bubble and when I was a PM at Soros and during those days, even then there were people talking about owning one's own data and data privacy. And I'll never forget, Scott McNeely then said, if you think you had privacy, forget it, you don't have any. And that was 26 years before today, where it's infinitely worse. So I will get to a question in a moment. So with all of that as a preface, and then as recently as last week, I was listening to something on a suspicion as to who Satoshi Nakamoto was, with one of that there was a thought it's one of the cyberpunks. And my question, is there any hope of changing the model from the FANG and Mag 7 and big tech and the ownership of the data to individuals, or is all hope lost on that?
So I see it as there's sort of two questions in there, and one of them is about legal definitions of ownership, and then there's another one about business models on the internet. So let me take each one in turn. When it comes to ownership, I do think there's been a real distortion of the notion of what you own and what you don't own online that needs to continue to be revisited. Let's take, for example, you writing a piece. Like I write my newsletter using Google Docs, not least because I worked at Google, but I also really like it as a product. I publish it using a platform called Beehive. Neither Google nor Beehive are going to claim that they have the ownership over my words in the sense that I can't have them, I can't do anything with them, they have control over it. On the other hand, when you look at something like your social graph on one of these social media platforms, it's very unclear whether you own that or whether that is in some way a derivative of your use of the platform, and therefore you're not entitled to take it anywhere. I do think we need to rethink this notion of ownership. And I'm not going to claim that this is something where there's an obvious legal precedent that we're applying. I think this is something more foundational. And I use words like revolution and talk about big historical trends, both guardedly, but because I do think these things take time. If you think of the notion of copyright, really wasn't a meaningful doctrine before the advent of printing in Western Europe. Because, Michael, if you wrote a book and I wanted to steal it in 1300, I would need a collection of monks and it would take 6 months or a year or whatever to write one copy of your book. Good luck trying to make money by selling it. Fast forward to after Gutenberg in 1450, by 1500, if you print a book and I want to steal it, I take a copy of your book, I give it to my printer, I say, knock off a few thousand copies, and now I've stolen your words and I'm making money. It took hundreds of years to develop copyright law. England only passed its first copyright law in 1710, so 260 years after Gutenberg. I think we have to revisit this notion of ownership. What's yours? What's the platforms? What's the nature of that value exchange? And that speaks to, I think, some of what you're saying. We need to get to the point that our relationships, our ideas belong to us. We may have chosen to use a given platform to assemble and manage them, but that does not mean it belongs to the platform. So that's kind of on the ownership side. I'm probably a little radical on that, and it could take decades or hopefully not centuries to revisit. But the other part you're talking about is talking about the business model and sort of, what's called surveillance capitalism, the idea that your data is being harvested and used. There are absolutely privacy concerns. Setting that aside, because we're talking a bit about business, I have a less optimistic, less idealistic view of changes in human behavior. Asking people to say, well, you shouldn't use a useful free service because that company is offering this for you free due to some data practices that are maybe not ideal or objectionable is going to be a hard sell to average people. I sort of compare it to food. There are a lot of reasons to think about whether you want to have organic food or locally produced food. Maybe you believe in vegetarianism. Maybe you're a vegan. Maybe you just think people should not be eating heavily processed foods because it's not as good for you. Those are all worthy notions. But at the end of the day, despite decades and decades of that work, enormous percentages of Americans still eat at fast food restaurants, buy hyper-processed foods at their local grocery store or Walmart and so forth, because the stuff is cheap and it's palatable and people are used to it and enjoy it. That doesn't necessarily mean it's great. I'm not saying that's the best thing in the world, but it's a little bit unrealistic to think that you're going to cause a massive awakening where everyone is going to change. I think what's important is people having the option. You don't have to sign a contract with McDonald's where you're only allowed to eat at McDonald's for the next 3 years. You can, again, exit and eat wherever you want. And that's where I think the challenge is online. You're sort of in this world where the only available options are these sort of free trade-offs. And it would be better if we had more options and easier exit.
Yeah, I mean that's all sensible. Let's move to a third topic of this podcast: systemic risk and information and integrity, and perhaps information warfare. At Jigsaw, you were on the front lines of disinformation. Is information integrity now a systemic risk like cybersecurity? And the second part of the question is, how should an asset owner perform due diligence on a company's vulnerability, for example, to deepfakes and AI-driven market manipulation?
Yeah, it's a great question. It is absolutely a mammoth risk because the tools and technologies that adversaries use are great and there's great financial return in it. So you're continuing to see advances in adversarial behavior. I did spend some time at a little branch of Google called Jigsaw. It's a great organization that's working to advance civil society and protect civil society online. When I was there, they were particularly focused on digital conflict and threats. And we did look at misinformation, disinformation. And then I saw when I was working on counter abuse, a lot of the kinds of scams and harms and spam that were out there. I would say the common thread that I saw throughout all of this and would be the risk I would recommend asset owners and investors be looking at is an enormous percentage of all of these problems stem from invalid accounts and deliberate misrepresentation. It is remarkably easy to get hold of an online account from a digital platform that allows you to reach millions or billions of people with very little supervision. If you compare it to banking, you have enormous amounts of know your customer requirements. You have reporting for large international money transfers in an attempt to fight money laundering. You have all kinds of regulatory oversight around accounts and what happens. I'm not going to say that that stops all financial fraud, certainly, but I would think that most of your listeners would agree that the oversight and regulations that exist in finance came from past abuses and are doing a job to try to make at least the easiest kinds of abuses harder. If you look at online accounts, when I was at Google, there was a team that was monitoring sort of the dark web for buying stolen or invalid accounts from different platforms. And for most platforms, you could get an invalid account for less than a cup of Starbucks coffee. With inflation, it could be even cheaper now. I will say, in defense of my previous employer, Google accounts were significantly harder and more expensive to get hold of, but most of the social media companies, it was trivial. And that's because these companies are motivated around growth and showing growth, and making it harder to get an account is the worst thing you want to do when you're trying to grow as a sort of optional lifestyle product. So the risk I would encourage investors to look at is what kind of controls does this organization that you're investing in or thinking of investing in have over account creation and setting up accounts? How much power does a new account get? Can you create a new account and immediately be reaching an enormous number of people? Is there a soak-in period where you have to demonstrate good behavior? Do they have efforts to identify the real human behind an account in order to reduce repeated exploitation? Or are they kind of just opening the floodgates because it makes their top line numbers look good? If a company's doing that, they're opening themselves to an enormous amount of risk.
Which is probably many, most, if not all, right?
It is still a situation in which people are rewarded for showing top line growth or profitability more than all of this. And what's hard as an investor and as a company that I want to recognize is a lot of the harms we're talking about here are external to the firm. If you're running a social media site and tons of people are getting catfished and scammed out of money, it's not your money, it's your customers' money. And if you're giving the platform away for free and showing ads, it may not have much impact on your numbers at all. It is economically rational, if socially incredibly undesirable, to sort of disregard those externalities. One of the things I looked into was, how did the Hudson River get polluted over decades and decades? And a lot of it tracks back to General Electric and General Motors, who had plants further up the Hudson River who were dumping chemicals and paint and so forth into the river. There used to be a joke. You could tell what color they were painting the GM cars that day based on what color the Hudson was turning.
Yeah.
Now, today we look back on that with horror, and we're really concerned about it. And there have been billions of dollars spent to try to clean up the river, and it's starting to bounce back a little bit. But the thing to remember is that pollution was not necessarily illegal at the time. It's not clear that GE or GM were breaking any laws when they were dumping chemicals into the river. It, in retrospect, was something that we wish didn't happen. And that's a hard
Just a quick
problem when you
question.
talk about ethical investing. Do you invest in something because it makes money, or do you try to change things in a way that might cost you money but is better for the rest of the world?
Well, I can answer that. I mean, that's again. So I've run significant portfolios for Dutch pensions and as well as for hedge funds and family offices, and the answer is it depends, right? Some asset owners, like at the extreme, like a Dutch pension APG that I used to invest capital for, had responsible investing, which was effectively ESG, as one quarter of their fiduciary duty, and then at the other extreme, some hedge funds and family offices I've worked for and invested capital for, the mandate was profit. And obviously there was no interest in doing harm or intentionally doing harm, but it was not a factor. And for, a lot of asset owners, or frankly, for many or most asset owners, responsible investing is inherently not a part of one's fiduciary duty. And again, this gets to one of the genesises of this podcast, which is ESG and how different asset owners deal with it. And some over time have increasingly incorporated it, and others have said, look, like when I first ran capital at Soros, where George's view was make as much money as you can on the hedge fund side and don't look to do good there. However, use that profit and deploy it via the foundation to do good. So that's my long-winded answer to that. I don't know if you have any thoughts.
Yeah. I think that makes a lot of sense. And looping back to your first question about regulation and the legal process, I think there's a very interesting question here about what sorts of regulations are needed to manage externalities and avoid things like the tragedy of the commons. We now do have environmental laws that mean you're not going to have another GE or GM polluting the Hudson River legally. If you look at the food and restaurant industry, you have food safety laws because there were abuses and there were harms and there were incidents of food poisoning. So now there are constraints in certain markets. We say we want business to be as successful as possible without imposing these unreasonable harms on the rest of us. And I think that would be an interesting area to start talking about for these online platforms. It's great for your bottom line to just allow really easy, rampant account creation and deal with it later as a trust and safety matter for some minor percentage of your revenues. Just like I'm sure banks would make more money if they didn't have to worry about money laundering. But maybe we need that kind of intervention to say, as an internet company, you cannot act with sort of reckless disregard and negligence over these harms. You have to take at least some kind of basic measure.
Yeah, no, that sounds right. Okay, and then let's shift to the fourth topic of this call, the Mag 7 and hyperscaler shift. And this is perhaps less in your wheelhouse, but nonetheless, I'll ask it because I personally think it's topical. And my question, though I don't have the answer, I have a suspicion, or fear, would not fear, I guess if I were a shareholder, suspicion and or fear if I were a shareholder, and the question is, are the Mag 7 shifting from high margin monopolistic cash machines into capital intensive commoditized hyperscalers where the cost of AI infrastructure structurally changes their models for the worse? And curious if you have a thought on that.
I don't have an authoritative thought, but I see parallels and things that harken back. When I was at NYU Stern, I was lucky enough to take Aswath Damodaran's class on financial analysis and investing, and I know he was a guest on your podcast. He's a legend. All of you listening to this, you should go listen to him. He's smarter than me. But I remember he
Me too.
talked a lot about things like the importance of dividends and so on, which is when a company ends up with these enormous cash flows and cash on hand hoards, it tends to drive this feeling of we got to do something with it. And so that's one of the rationales around wanting more aggressive dividend practices is give it back to the investors and let them decide where to allocate capital. So I think that's an interesting thing when you look at a company like Google with just a giant amount of money, or the investment firms who have huge funds and are looking for places to invest. I think there's an element of that in what's going on. The other thing, and this is not an original thought to me, but I find it persuasive, is the parallels between the dot-com boom and the AI build-out that's going on right now. If you remember in the dot-com boom, you had enormous investments in connectivity. You had people laying new fiber optic cables across oceans. You had investments in technology. You had companies like Nortel sort of blowing up on all of this. You had a whole bunch of startups with really promising ideas that were just bleeding cash. And you eventually had the dot-com crash and a huge correction. But the underlying trend had not been invalidated, and you then had other companies coming on later buying up those assets at a discount and eventually needing more. We need way more connectivity today and more bandwidth than at the peak right before the dot-com crash. Lots of companies went under because they had mistimed the market or they didn't have the economics right. WebVam died, but now we have Instacart. Pets.com died, but now we have Chewy. You can sort of do this bit by bit. So I think we're in the middle of an aggressive build out, not necessarily because it's the new normal, but because there's an opportunity that can be captured with the application of capital. There is a strong feeling that this is a meaningful, if not generational, technology opportunity. And we're seeing that with things like Anthropic might actually have underinvested in its technology and in its platform base and maybe having trouble meeting the demand. Is there going to be a correction? Well, there's usually a correction. But then all of this investment may pay off in the recovery phase.
Yeah, look, we both lived through the first tech bubble, and as I mentioned it once or twice on this call, I was a PM at Soros during it, and yeah, look, to me the parallel is significant and material. We had an overinvestment, as you alluded to, in fiber and infrastructure. I think now we have an overinvestment in compute and data centers. However, just as that fiber was initially overbuilt and then subsequently used, and more was built, and my view is it's sort of similar. Like there will be at some point in the short to medium term future, there will be a point at which there will have been overbuilding and everything will go the other way. And then after that, it'll go up exponentially, just as fiber data, the demand for all of it went up subsequently. So, and anyway, my view is we would probably due for a short-term hiccup at some point, but followed by long-term growth. All right. And then let's talk about the public interest, let's call it the public interest technology gap. So you move from the heart of Google's ad business to the public interest sector. Is there a sort of green bond equivalent for public interest technology that institutional investors should be looking for or thinking about? And then this related to that, is there a principal agency conflict where the companies have their own profit? I guess we kind of talked about that before, but let's just stick with is there a green bond equivalent or a public interest tech that institutional investors should be looking for?
I wish there was. There's a lot of really important work being done that points in the direction of a better future. The company Blue Sky has gotten a lot of attention, but what's underlying Blue Sky is a new protocol for open social media called the Protocol. And there are early stage investors in what's broadly being called the atmosphere. There's a really promising small company called Black Sky that has been building community tools initially for the Black community, but they're now expanding to help build other communities. You have the what's called the Fediverse, which is a different protocol called ActivityPub, a software platform called Mastodon that's been very involved in that. You have a third one called Nostr. Jack Dorsey has put together a $10 million fund investing. And so there are a lot of early stage green shoots around new and better ways to do all of this. I'm not sure that any of them have hit the critical mass to become a business opportunity at scale yet. And I think that's one of the things that people are starting to look at and look towards is where is there a new economic model and where is it going to be? One other one I would want to mention is something called the First Person Project, which is an effort to build sort of self-sovereign identity and networks of trust, which is a way to approach some of that "it's too easy to get an account" problem that I was talking about. I'm not an expert on green technology, but I wonder how much this looks like the earlier days of things like solar and wind, where the cost was maybe a bit higher. It didn't necessarily look price competitive with fossil fuels, but the continued investment in the technology, changing the costs and coming up with solutions to problems eventually starts to hit inflection points where we have a lot of countries around the world seeing that solar and wind and water are actually working as well and in some ways better for them than fossil fuels without some of the geopolitical risk. So I think it's a great opportunity right now for early stage investors. I don't know if there's a vehicle yet for doing it at scale.
Got it. Okay, fair enough. Okay, shifting to the last segment of our discussion, AI ethics and regulatory alpha. Let's start with compliance versus resilience. With the divergence in Europe, US AI regulation, how should an allocator distinguish between companies that are merely legally compliant and those that are ethically resilient? And does this matter? Will it be reflected in profit or the success of the companies?
So I have I don't want to say a dim view of human nature. That's a little too dramatic. But I think that anytime you're basing your belief about where a firm is headed on something like the ethical framework of the current leadership, it's always going to be a little bit fragile because you never know if you're going to have a change in leadership, a change in commercial incentives. Things could go in different directions. I mean, OpenAI has been drama candidate number one for this, from being a research lab to the drama around Sam Altman getting fired and then being brought back in and converting to a for-profit entity. You had Ronan Farrow's long piece about Sam Altman in The New Yorker, raising all kinds of questions, none of which necessarily has a whole lot to do with the business results that the company is having. But it does raise questions about, do you have any of this deeper sort of systemic risk? I think that maturity of governance, we've talked about governance in the sense of governments in imposing things, but there's also questions about the way these companies are operating internally. I wrote a piece in my newsletter a while ago talking about where does trust and safety, ethical work live inside organizations. And I do think that has a big effect on a company's effectiveness. And think about a couple of options. If you're doing your safety work inside the business unit that is motivated around generating revenue and profits, you're always going to have this problem of, well, if we cut our trust and safety investment a little bit shorter, we'll have less of a drag on launching new things. We can have a little more profitability. You're going to tend to get an underinvestment. If you put trust and safety inside the legal department, maybe now you're a little bit insulated from business imperatives, but a lot of times the legal function's job is protecting the organization from legal risk. And the trust and safety decision that is good for the company from a legal risk point of view isn't always going to be well aligned with what's good for your users, your customers, for society. There's beginning to be more of a trend in financial compliance of having those compliance teams reporting directly to the CEO, or even having a dotted line or even a stronger line to the board, giving them some independence even from the CEO. And I've seen some work that suggests there's a lot of benefit to that, because then you can have a bit of a more objective decision about what kind of risks you're taking on and how. So that would be what I would be more looking at, is how mature is an organization in thinking about these sorts of things? Are they setting up durable organizational structures around trust and safety, or are they just kind of reacting to the latest bad press?
Got it. Understood. Okay. And then the last formal topic, the efficiency paradox. Will AI-driven governance make platforms more stable for investors, or the opposite, I guess? I'll just keep it simple.
Yeah, no, that's a huge question. And I'm going to answer it in a civilizationally hubristic way, which I'm self-mocking myself for even approaching it in this way. But I do think it's relevant in that, coming back to these questions of democracy and governance, the evolution in different forms of government has come historically from changes in the complexity of human life, the size of the human population in the world, the size of communities, the types of technologies we're managing. Some work suggests that early sort of hunter-gatherer societies kind of had a roughly democratic, roughly egalitarian way of doing things, because you were dealing with communities of 20 to 150 people, and you all needed to team together in order to survive. And it was possible for everybody to kind of get together in one place and talk things out. You move on to things like, I mentioned Athens, which was not a democracy by our current standards of participation, but was a democracy within the subset of male property owners who had a say. You had to have a way of running the city that allowed someone to be in charge, but you could still bring together large groups of people to make decisions. The trial of Socrates, the jury was famously like 500 people. The rise of what we think of as democracy today as representative democracy is very associated with the nation state. You had people coming together in larger groups, larger geographical gatherings. You couldn't just get everybody together in one city. Cities and other communities had to elect representatives to go to the capital in order to make decisions on their behalf. And so democracy evolved again. The reason this loops back to the questions of AI is we've never had more humans on the planet than we've had now by a large degree. We've never had more complexity in terms of the technology that we use to run our lives, the nature of the communities and societies that our lives are involved in. We have this entire online dimension to our world that did not exist before. We have avalanches of information at a scale that would be unfathomable even 100 years ago, even 50 years ago. It would be hard to imagine. And I do think it's straining the way we govern ourselves and the way we make decisions. And there is an enormous amount of potential for AI to make a difference in what's often called in the area sense making. Can you analyze what everybody's saying, what everybody's doing, and help distill, well, what are we looking at? What are the possible areas of agreement? There's a lot of great work being done in deliberative technology, both at the lab I worked at Harvard. The Applied Social Media Lab has done work in this area. MIT has done work here, Stanford, lots of places. My old group at Jigsaw, looking at AI for sense making and helping to refine governance. There's also been really interesting work in using AI to improve enforcement, to replace those sort of infamous farms full of humans being forced to look at terrible content every day. Can you use AI to do that at scale, do it more accurately, do it without traumatizing people? So I think there is potential for AI to allow us to figure out how to govern ourselves in a better way. I do want to say there's enormous, enormous risk to all of this, because the notion of an AI who's better at reading everything you write online, watching every video online, looking for violations of policies is also a recipe for ungovernable surveillance at scale. And this is why companies like Palantir, as important as they are, and as inevitable some of that technology is, it also freaks people out, because we haven't figured out what does it mean to exist in a world in which computers can identify both real crime and thought crime.
Or potentially engage in it itself. But that's another whole discussion we don't have time for. Okay. Any last very brief piece of advice for allocators or investors in the context of this discussion?
I would say look at past examples when there have been known externalities in a market that eventually get corrected. You had automobiles before Ralph Nader and Unsafe at Any Speed. You had the spate of airline hijackings in the airline industry before enhanced safety went in, going back in the 60s and 70s. You have everything around tobacco and the litigation and the legislation there. I do believe that the internet and internet companies, and by extension AI companies, are in a similar situation right now. A lot of their profits and a lot of their success comes from being in a early, either pre-regulated or loosely regulated stage, and there's likely to become more legislation and more requirements that they handle the external harms. There are probably smart investment strategies if you're in one of those markets, and looking at the internet in that way should lead to new opportunities.
Okay. On that note, we'd like to thank you for the fascinating discussion that I think many, if not most people, are not talking about, and sharing your most valuable asset with us, your time. We hope listeners have a better appreciation for this subject that I think, that I think we both think is important and will become increasingly important, and that what we should be thinking about as humans as well as investors and allocators. This is your host, Michael Oliver Weinberg. Looking forward to your joining us again for our next episode, where we speak with another world-leading thought leader who'll provide insight into improving alpha via innovation, investing in ESG. Thank you, Jonathan.
Thank you very much. This was great.
Thank you for joining us on the Improving Alpha, Innovation in Investing, ESG and Technology podcast, presented in partnership with Vidrio Financial and sponsored by Alternatives Watch and PEVC Tech. Vidrio Financial offers a cutting-edge data management solution that not only collects and cleans your data, but also empowers investment teams to cut through the noise and extract valuable insights for better decision-making in areas such as valuation, risk assessment, and portfolio management. If you're an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office facing challenges with your data pipelines, we invite you to connect with us today and explore how Vidrio can seamlessly integrate with your investment team to enhance your data management capabilities. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.